So this bank, its basic primary job is to issue dollars and to issue them in a way that we have a stable currency, so that when the money supply gets tight, the Fed creates more dollars out of thin air and increases the money supply. And then when there's too much money out there, which creates inflation, the Fed like sucks in the money, like kind of draining a pool, brings money out, cools it down.
Hello, listeners. Today I chat with Chris Leonard, who is an author and an investigative journalist, and he wrote this book called The Lords of Easy Money. And it's all about how the Fed printed a bunch of money and kind of hurt our financial system and hurt the U.S. economy. And so we dive into this. This is like a alpha leak episode from an investigative journalist where you're like, oh my God, I can't believe this is what's been happening with the Fed. So, we first dive into the mechanisms of how it works, how the Fed prints money, how that connects to the central banks, why it's a kind of a plutocratic system. And then we kind of look at the history, from the 1900 through today about, when the Fed was created and how this has happened in the past, where the Fed has printed too much money in the 60s and then had inflation in the 70s and had to reel it back. And how even then they printed too much money before quantitative easing, before zero interest rates. That was when interest rates were 5%, 10%, And so we kind of contextualize the current moment in history. And that allows us to see these different kinds of inflation, where not only is there price inflation, like, the cost for your car, the cost for whatever, but there's also asset inflation, which is just the stock market go up, orange coin good energy. And that asset inflation is such a huge part of just like money printing. It goes into the vaults of these central bank or of the commercial banks, and then they're searching for yield, and then they just put it into these assets, and the assets go up. And so that's the reality we've been now living in. And this kind of third big piece is the age of easy money, and when we have all this money printing and how it creates these massive bubbles, and how we, the way Chris talks about is 350 years worth of printing in 4 years. We went from 1 trillion to 3 trillion, and then 3 trillion to 9 trillion, all in a really fast period of time. And so it's not a good situation. And so then we kind of look at the end where we say, okay, we've created all this inequality, we've created all this risk, we've created all this debt in the system. And so what should we do? What should the Fed do? Should they keep interest rates high so that it flushes out all the bad parts of the system? And I think, that's probably right, but it's gonna be kind of a decade of difficulty there. What should individuals do? What should you buy? Not financial advice. And then what does this say about the state of capitalism and the state of reserve currencies, the U.S. government and the U.S. empire versus, China on the rise. So it's a good deep dive on all those topics, and I hope you enjoy it. If you like it, don't forget to like and subscribe on your favorite app, and feel free to leave a rating or whatever. We really do appreciate it, and trying to bring you and help you understand at a foundational level what's happening with these important things like the state of the economy and how the Fed kind of impacts that. So with that, I hope you enjoyed this episode with Chris. Hello, Reese's Pieces. I'm Rhys, the co-founder of Root, and welcome to The Rhys Show. I believe the best way to predict the future is to build it. And so I'm interviewing pioneers on the frontier to understand what the world will look like and the secrets behind how they're building it. These are insights from the frontier. And today, I'm excited to chat with Chris Leonard. Chris is an investigative journalist who's written 3 books, the most recent of which is perfect for our Silicon Valley Bank moment. And it's called The Lords of Easy Money, How the Federal Reserve Broke the American Economy. Chris, thanks for being on the show, and welcome.
Thank you for having me. Good to be here.
Yeah, excited to dive in. It was funny before the show. I checked with Chris on the intro, and I had accidentally put a T at the end of his name. So it was like, welcome to Christ. Christ is on the show. And Chris was joking to chat about monetary policy. It's like, that's what Christ has risen from the dead to chat about.
Yeah, let's hope if he comes back, there are bigger things to talk about than Silicon Valley Bank. But I'm here in the here and now to talk about that.
Exactly. We don't have Christ, but we do have Chris, which is good. It was the second. It's kind of like you're looking for Beyonce, but you only get a really good.
Totally.
So as Chris and I were also chatting about before the show, the goal is to kind of get in the mind of a smart listener who's seeing what's happening with the macro economy and banks, and Silicon Valley Bank is going, okay, SVB just kind of failed, and there's also all of this. We had this money printing thing that was happening with quantitative easing, and now we're kind of the interest rates are changing, and so to kind of like understand all of that and what it means for both people's day-to-day lives, but also for kind of like the macro global economic system. So with that, Chris, and as a note for the listeners, yeah, this Chris wrote this great book, The Lords of Easy Money, which is really, it's a good dive into kind of how the Fed operates and all of this stuff and what kind of the last couple decades have been like. But before getting into that, Chris, I want to ask you, what made you want to write a book about monetary policy?
Yeah, never thought I would be there, honestly. So I'm a business reporter, but and an author, and I feel like my main thing is I like to write about really really powerful institutions, describe how they work from the inside, describe how they use their power, how it affects all of us on the outside. I wrote a book about Coke Industries, the Koch brothers company. Wrote a book about Tyson Foods, the biggest meat company, to talk about agriculture and rural America. Okay. I was honestly minding my own business, reporting the book about the Koch brothers. And that book put me into contact with a lot of really brilliant financial trader type people. Like, you wouldn't think this, but Koch has built a financial trading desk that rivals anything at JP Morgan, Goldman Sachs. So I was interviewing this guy who's really, really brilliant. And we talked about Coke for a few hours, but then he really wanted to talk about what he was seeing in asset markets. And this was like 2016. And this guy walked me through, he was like shell shocked. He's like, you would not believe what's going on right now. And one of the headlines he gave me was, the Federal Reserve has printed 350 years worth of money in about 4.5 years. In other words, between 2008 and 2014, the Fed printed 3.5 times as much money as it printed in the first century of its existence. And then this guy started explaining to me how this money was created in the Wall Street banking system, how it was pushing the big banks to speculate more, just pushing all this cash out into the riskiest investments, corporate junk debt, tech stocks, all the rest of it. And I was like, dude, this guy's got to be crazy. Is this guy exaggerating? Is this just one point of view? And that's what really got me on this. I started reading every book I could, every magazine article. I started interviewing people, and sincerely, like I did not think there had even been a very good deep magazine article about these Fed policies, like quantitative easing in the 2010s. And so I really like truly got obsessed with it, and I just felt like this is one of the most important things that we've got to understand, like this policy, this institution, and that's how I got on it.
Yeah, I love that. That's a great, when you start to hear something like, okay, this person's either crazy or like correct. And then you're like, oh, let's like double click here. And you're like, oh my God, you kind of can kind of see the unraveling of this. And so maybe, so that, and let me actually want to ask you one other question before we go into like the Fed piece. What about you as a person makes you like to kind of explore as a human, like explore these institutions and how they work and what's going on within all these acronyms?
Okay, I mean, like, first of all, I don't know.
Yeah.
I just know I love it.
Yeah.
But I mean, okay, I mean, really quickly, like, I've always loved writing. You know how everybody you talk to probably has their thing that like they react with and love? Okay, writing was mine. Reading and writing books. I'm a book freak. I love bookstores. I love books. But then I discovered journalism in college and really fell in love with that, like interviewing people, talking to people, exploring the world, and then really developed this deep, deep sense of like public concern, or like being like a citizen in the broader world. Like, I was kind of a moron as a kid. And then like in college, I'm like, wow, there's this big, big world around me, and it really matters what's going on. And then, I won't, but, like 2003 with the invasion of Iraq, and like I was a business reporter in the collapse of Enron. That's what pushed me into wanting to be an investigative reporter. And I really love the work of people like Bob Woodward or whatever, who could just burrow into an institution and tell you how it works, if that makes sense. And so that's what I do for a living. And like, It just totally makes me happy. Like I get obsessed like a pit bull just on like what's going on inside these places, you know?
Yeah, I love that. It's a cool way to say. I think investigative reporting is of the most, because something just like news is just like, hey, here's a new thing that we're trying to get you to like click on or whatever. But like something like investigative reporting is like, no, society is formed of all these complex entities, and like we can tell you what's actually happening. Why would something, I just had this woman Jen Paulka on the show who talks about, she's like a civic tech person who went into government and tried to understand what is systemically happening in government that makes it so that they're not outcome driven but instead are kind of process driven, and so like trying to understand these things from the inside out, what's actually happening here that drives these outcomes. So that's cool to know. So let's dive into the Fed piece. So I guess just to give our listeners an overview, and I know for me, even 2 weeks ago, I didn't know very much about this. Could you kind of explain the mechanism of like, you have banks, you have the Fed. What is the Fed?
Yeah.
And how does that make inflation?
Yes. And I'm not, but like one of the things that bugs me so much about this is how the Fed is talked about most. Like most of the media coverage of the Fed is very much from the point of view of like a bond trader.
Yes.
Like, how high is the interest rate hike going to be? Is it 2.5 or 2.75? I mean, dude, you would think it was Watergate, like the level of intensity and energy that goes into like, is it going to be 2 or 2.75? And for most of us, who cares? But it really is like a fascinating institution. And I mean, if you rewind the clock back to like, let's just say like 1908, ballpark, okay? So during the presidential campaign, Williams Jennings Bryan gives this speech and he says, mankind shall not be crucified upon a cross of gold. Have you ever heard that saying?
No.
It's probably one of the most popular political phrases about monetary policy ever. And what I'm trying to get across there is back in 1908, like the politics of currency was a retail level political issue. The way we argue and shout about guns and abortion, like that's how they used to talk about currency and monetary policy. Cross of gold was money policy. And back then, we didn't have a central bank in the United States. Like, we're like a federalist country, very skeptical of centralized power. And we didn't want to have a government run central bank in the way, say, like England did, because we're really skeptical of that power. So this is interesting, by the way, like from a tech perspective, Silicon Valley perspective. In the late 1800s, there were literally thousands of currencies in the US. Thousands. And banks could like issue their own currency. And I guess that to me, it's like the whole cryptocurrency, Bitcoin thing is like, we've kind of tried that to a degree. And the late 1800s were a disaster. We had these like really frequent bank panics. We had these long periods of deflation. You can't really run like a sophisticated capitalist economy without having some kind of central bank to manage the currency. Okay. So we created the Federal Reserve in 1913 so we could have a national currency. The thing you and I call the dollar is a Federal Reserve note. Okay. So this bank, its basic primary job is to issue dollars and to issue them in a way that we have a stable currency so that when the money supply gets tight, the Fed creates more dollars out of thin air and increases the money supply. And then when there's too much money out there, which creates inflation, the Fed like sucks in the money, like kind of draining a pool, brings money out, cools it down. And that's the job of the Federal Reserve in essence at the most basic level.
Cool. Yeah. So you have, and as you said, there was the era of wildcat banking and stuff, and it was just kind of Wild West energy, and then all these bank panics and stuff after that, and then it was like, okay, let's actually have a stable thing that can be a medium of exchange and a unit of account that actually works and isn't going up and down in these crazy ways. And so so tell us about that kind of, when they push money into the system, there's like the money printer go burr meme or whatever. Like,
Oh my God.
how does the Fed actually produce? How do they actually push money into the system, and how do they like suck money back from the system?
Super fascinating. Great question, by the way. And this gets into my favorite kind of stuff, which is like the mechanics, not the theory, but the mechanics and the plumbing. And yeah, okay. But I do want to say this though, like I don't want to just bash and beat up on crypto and Bitcoin because there's a certain like theory that underlies Bitcoin that's important that we're going to get to in terms of like having discipline with creating money. Right.
21 million. There's only going to be 21 million. There won't be. You won't have a century's worth or 360 years worth of money printed within 3.5 years.
Exactly. I just want to make sure we don't like go past that. But okay, here's how here's how money gets made. Okay.
When the
Well,
birds and the bees, when a man loves a woman very much, when the Fed
exactly.
loves the J.P. Morgan a lot, well, what they do is they increment the dollar.
So true. When the world's biggest banks get together on Wall Street.
Yeah.
So you might have heard like the Federal Reserve got created at a literal secret meeting at a resort off the coast of Georgia called Jekyll Island. And these bankers got together and came up with the plan, which was then ratified and passed by the US Senate. But this is really key. They're like, okay, central bank's coming. We got to have it. Got to happen. But we don't want it to displace or totally take over Wall Street. So we're going to make sure that the Fed is going to be backstage and Wall Street is on the front stage. So the only way the Fed can create money is by making new dollars appear or disappear. We'll get to that part. But by making new dollars appear inside 24 bank accounts on Wall Street that are owned by these institutions that are called primary dealers. The primary dealers are exactly who you think they are: JP Morgan, Morgan Stanley, Goldman Sachs, Wells Fargo, and then more obscure institutions. But okay, let me explain it. Like the Federal Reserve Bank in New York City has a trading desk that looks like a trading floor at JP Morgan. It's just a big hallway, it's kind of like this open barn type room with just cubicles everywhere, financial traders walking around in their fleeces with their coffee mugs talking with each other. And there's this room in the corner with a trading desk where a Fed trader will sit down, call up JP Morgan and say, hey, I want to buy $8 billion worth of bonds from you. And JP Morgan says, agreed. JP Morgan gives those bonds to the Federal Reserve. And then that trader at the Fed desk in New York types into the keyboard and boom, $8 billion appears in JP Morgan's bank account to pay for those bonds. That $8 billion was created out of nowhere by the Fed inside a reserve account on Wall Street. That's how money gets created. That's how it happens. And I don't want to like get bogged down, but back in history, the Fed used to just create a little bit at a time and then take away a little bit, like tuning a piano chord in really fine little variations. They'd create a little, take a little away, create a little, take a little away. That ended in 2010 when the era of quantitative easing began, when we just started flooding the system with money.
Yeah, I love
But
that.
that's how money gets made.
Yeah, and that's a great. And I love imagining the people in their little Patagonia vest or their little fleeces or whatever, and they're kind of there, and they just hit them up, and they sit. And I think it's smart to know. It's like, and I think of it some like things that have helped me as I've gone down this rabbit hole. Like, yeah, that the Fed is kind of the banker's bank, and so the bankers have to hold their reserves at the Fed, and they have to hold whatever 10%, and so then they say, hey, and then so that's kind of one piece of it is these reserves, and they increment those reserves that the bank has with the Fed. And then the other piece that you said there that's just crucial is like there are these bonds, and the bonds are kind of these long duration instruments, that's like a 10-year bond or a 5-year or 20-year bond. And what they do is they kind of exchange that long duration instrument for the short-term liquidity of just cash. And then that cash goes back out into the world and kind of can do its thing. So how does the vice versa happen? How does the money get sucked back from the system? If I'm JP Morgan and I have those $8 billion and you're the Fed and you're like, hey, can I have them back? Or how do they get them back?
Yeah, like in essence, it's just the opposite. The Fed trader calls up JP Morgan and says, hey, can I please sell you a treasury bond? JP Morgan says yes. And the treasury bond goes from the Fed to JP Morgan, and those dollars go from JP Morgan inside the Fed. And at that point, and it gets abstract, of course, because money doesn't exist. Money's not real. And the money has now gone from JP Morgan to the Fed, and it's inside the Fed. And so I say the Fed has like extinguished or destroyed that dollar because it's pulled it out of circulation, it's pulled it out of the banking system, and it's sitting inside the Fed. So really, technically, I mean, the Fed Oh man, we're going to get the scale of money creation over the last decade is like impossible to conceive. Almost, it's gigantic. But the Fed right now could hypothetically suck $5 trillion in cash out of Wall Street by selling bonds. And I'm going to get a little bit shaky on this. I'm sure there's a lot of technicality behind it, but the reality is when the Fed buys and sells stuff, it doesn't play by the same rules you or I play by because it literally can make and destroy money. So it can buy a bond essentially for whatever it wants to pay without thinking about it, and it can sell a bond essentially for whatever price it wants to sell it for. So that's why creating and destroying dollars back and forth in this way doesn't obey like market rules. You know, the Fed can do this at will because it creates the money.
Yeah. That makes sense. Yeah, they're the only ones who just get to increment. You know, most people have to do double entry accounting where they say, well, I took off this amount, I increased this amount. And they're just like, let it be. And then a bond. The thing that I think is interesting about this, correct me if I'm wrong, but like bonds, whether it's a 1 year, 10 year, 30-year bond, that is just a long duration instrument that at the end you still exchange for cash, right? Or is that right? Or how does a bond after the end of the 30 years you get US dollars for it? What happens at the end of a bond?
That's right. And for the purposes of our conversations, we're really only talking about two kinds of bonds. And for most of history, we were only talking about one type of bond, which is a United States Treasury bond, US debt. And then the Fed, when they got into this era I write about in the 2010s, which was, let me state clearly, the 2010s were an era of wild and unprecedented experimentation in money printing, just like way off the charts. So during that era, the Fed started not only buying treasury bonds, but like mortgage bonds. Okay, let's just put that aside for a second. A treasury bond, like you're saying, is a really interesting thing. The United States government issues a 10-year treasury bond. And let's say, for the purposes of this doesn't exist, but let's just say it issues the bond for $10,000. Okay. So the Treasury gets $10,000 in cash, and then this bond exists. And the US Treasury effectively, and man, bond traders go crazy when you get a tiny detail wrong about
Yeah.
this. So, like, forgive me if I get really slow. Basically, the bond gets paid at the end, the entire amount. It's not like a credit card debt where I pay like $20 a month and I'm paying down the principal. It's like you borrow the $10,000 for 10 years, and then at the end, you pay back the $10,000
Got it.
in full.
Got it.
And there are payments along the way, and there's like discount to the final price and stuff like that. But basically, and that's how corporate bonds work, by the way. They're not like credit card debt where you pay down the principal, you pay the whole thing at the end. So, yeah, cash goes in at the beginning, and then at the end, all the cash needs to go to pay off the full thing.
Cool. Yeah, got it. Yeah. So you have the $10,000 bond, aka the U.S. Treasury gets their $10,000 in cash, and then the bond kind of exists out there, chilling, and then it's waiting. And if you're Silicon Valley Bank, you might have 86, or $1 billion of these bonds. And then the issue is that you can't convert them into cash until after the hold to maturity, the 10-year period. At which point you get to change the liquidity or you get to access the actual liquidity. So that makes sense. So I think we have a good view. Thank you for co-explaining that of like, here's how it works. We have the Fed. The Fed is kind of working with these central banks, the Fed is working with these commercial banks, these 24 of them. It can increment money in their accounts. That's kind of a political thing that happened in the early 1900s as a way to make sure that the Fed's in the back and these banks and Wall Street still have power in the system where all the new money that happens kind of goes to them first. It doesn't like go to the people or whatever. Before we get to the like 2008 and like the last kind of decade, tell us about the period of your book does a really good job of kind of diving into the 70s and great inflation and kind of how the Fed was operating before the era of quantitative easing. Tell us a little bit about that period and how that worked.
Okay. I'm not going to explicitly tie this to what's happening now, but it is hyper instructive, by the way. Okay. So the Fed's job is to manage the money supply. And I compare it to just these like engineers inside the control room of a nuclear power plant. You want the thing to be running, but you don't want the power plant to overheat or melt down. Okay. So you're going along decade by decade. You push more money out in the system when you need to heat up the reactor and you get it humming, but then when it starts getting too hot, you pull money out and cool it down, and you do this back and forth. They really made a huge mistake in the late 1960s. And by the way, this isn't Chris Leonard sitting here. They made a huge mistake. The Federal Reserve's own internal studies, which I cite in the book, which really have the benefit of hindsight. There's this epic study from 2004, which is a study of studies, okay, that says we screwed up in the late 60s, and here's how. We put too much money out there for too long. The core reactor melted down because here's what happened. In the late 60s, the Fed was printing more money, and the synonymous term for that is keeping interest rates low, keeping money easy and accommodative. And what would happen is they'd keep interest rates low.
Let me pause you for a second, just for the listeners. The interest rates low thing is the key idea is there is that if you have at the Fed kind of has a rate where they say, hey, if you want to get more reserves here, I'll give them to you at this interest rate. And so if the interest rate is 10%, then you're like, oh man, in order to get more money, I have to pay 10% later. So like, I need to it's going to be hard to get this extra money. But if the interest rates are zero, then it's just like, oh, I can just suck in free money and then use that free money for these other things. And then when I give it back to the Fed, it's kind of, there's no cost to pay on it. So I just wanted to kind of make that tie for the listener. If that's what low interest rates, how they create more money in the system.
Yes, 100%. And by the way, zero wasn't ever on the table until 2008, and it's then been
low
zero.
Interest rates here are 5% or something.
Exactly, dude. They were 9% in this period I'm talking about. And so low interest rates equals more dollars out there in the economy. Higher interest rates is a way of thinking you're sucking those dollars into the Fed, cooling it down. So what would happen is the Fed would lower rates in the late 60s and print money, in part, by the way, to fund the Vietnam War, to do all this stuff. And then inflation would start to rise. And the best way I've heard it described is you've got too many dollars out there chasing too few goods. Demand is really high, lots of dollars out there trying to eat everything from, cars to televisions, hot dogs, gasoline. And so when inflation started to rise, the Fed would try to cool it down. They would try to hike rates, suck that money back in, and it would cool inflation, but then it would start to hurt economic growth. And jobs would start to get cut. And the Fed is not they're not democratically accountable to the people. The people who run the Fed aren't elected. But I read this great history written by this guy, Alan Melters, this huge, long history of the Fed. And he's like,
was that the one that was 2,100 pages, by the way?
Exactly.
Oh my God.
And dude, I can't lie. I did not read the whole thing.
Yeah, I was going to say, wow. Yeah.
No. I've read a lot of it.
Yeah.
I've read a lot of it, and it's down to the minute stuff. This guy was obsessed. He was a professor of economics at the University of Chicago. And he wrote a almost day by day minute of the great inflation. And his point was, the people who run the Fed are human beings. They read the newspapers. They watch TV. When jobs are getting lost, unemployment's rising, the economy's slowing down, the president's talking about it, they react. And it's a subtle thing. This whole idea of Johnson bringing the Fed president and poking his chest in the White House, or Donald Trump beating the heck out of the Fed chairman Jay Powell with Twitter. That's such a cartoonish version. This influence is very subtle and happens subtly. But in the late 60s, the people who ran the Fed were oh my God, unemployment's rising, cut rates again. Okay, and they would do that. And then inflation would rise, they would hike rates, but then it would get bad and they'd cut rates. It was this back and forth oscillation that was happening that pretty soon just made inflation explode. So that by the middle 70s, inflation is double-digit growth year over year. And this is the period when we really talk about the great inflation, the lines of cars outside the gas stations, people hiking up meat prices in the middle of the day at grocery stores. And this is what's so important. Inflation at that point is out of control, totally out of control. It's embedded in the economy. people, when there's inflation, they expect more inflation, which pushes them to do things that increase inflation. It's a spiral. And the spiral happened because the Fed was doing this two-step back and forth of like cutting rates, but then raising them, cutting them, raising them. And they let inflation gather strength and then just combust.
Yeah, yeah,
So that's how the
interesting.
Great Inflation happened.
Exactly. And I think the crucial thing is that, yeah, there's, as you said, it's like if you're just out there kind of pumping too much money into the system, and if you're kind of tuned into the what the news is saying, and being humans, tapped into nightly news or tapped into Twitter or whatever it may be, you're gonna be like, oh man, and like unemployment bad. Let's just like make sure that like people don't get unemployed, and so like let's keep pumping money into the system. And then what happens in the end? It's like, oh my god, way too much money in the system, too much money chasing too few goods. So let's kind of, and I think that frame for me was really helpful too in thinking about previous bubbles too, where just like pumping money into the system makes bubbles, and whether it's 2000 with, .com bubble, it's like there's easy money and that money is flowing into the tech industry. It's like some of that is truth, which is that there is exciting things, and Amazon and Google and all these things are being built. So it does make sense that there's some amount of excitement there and some amount of real value at the end. But at the same time, if it's just like, if there's money flowing around, then it's going to kind of create these kind of bubble-like environments. So kind of bring us into 2009, 2020, the era of quantitative easing, the era of easy money. What's going on here, and why is it so different than the past?
Yes, let me start at '08. And really quick, when I wrote the chapter about the 70s inflation, I called it the Great Inflation parentheses S, the Great Inflations, because you just described a really important point. You've got price inflation, which is what we all talk about and think about: gasoline, cars, food, price inflation. But then you have inflation in asset prices. And an asset is anything you can buy that holds value. And the most typical kind we think of would be stocks, shares of stock, real estate, corporate bonds. Things like that are assets. When the Fed prints too much money, it can create inflation both in prices and in assets. During the 1990s and the 2000s, the Fed had the easy money policies kind of back and forth, which really accelerated into the 2000s, but like price inflation remained tame, interestingly. And I kind of go into it, but it big issue there. But let's just suffice it to say we never really saw price inflation. I think it's fair to say in hindsight that's in at least in large part because the globalization of the economic system, the trade, the new entrance into the labor force, that was super deflationary, this whole system we built of international trade. We saw asset inflation though. And that's really, let's get to the 2000s. The Fed kept rates low to stimulate the economy. '01, '02, '03, '04, particularly '03, '04. And as a reporter, everybody loves beating up on greedy bankers and short-sighted, idiotic mortgage loan companies like Countrywide. Like that all was real for sure. But the Fed, by pushing so much money out in the system, by keeping borrowing costs so low, it was feeding that. It was like enabling that, the fraud and the greedy bankers. This was all part of the, you know, dumb mortgages are weather. Fed policy is climate. Like the Fed was creating the climate. And so that played a huge role in the housing bubble, building, and then correcting, crash. And then you had the contagion effect because all the derivatives and stuff like that. Okay. But it was really in responding to the crash of '08 that the Fed steps in. And the chairman of the Fed at that time was Ben Bernanke, who'd been the student of the Great Depression, well, a professor who taught about the Great Depression at Stanford. And he's like, okay, the big lesson is they kept money too tight during the Depression. We're never going to get caught doing that. And so they printed $1 trillion to stop the bank panic or the global financial crisis of '08, which, by the way, was as much money as they'd printed in the first century. So, good way to measure this is Fed balance sheet, which goes from 900 billion to north of $1 trillion in like 6 months ish, 9 months, maybe a year. Let's just say a year to be safe. That's a doubling of the Fed balance sheet. But then the critically, like my book starts in late 2010, and this is a different moment. The global financial crisis is over. We're not heading into a recession in 2010, but growth is weak. And that's when Ben Bernanke says we're going to try this experiment of money printing called quantitative easing. So we're going to hold interest rates at absolute zero, which per the conversation you and I have had, that's like pedal to the metal on easy money, 0% interest. And at the same time, we're going to print like $1 trillion in a year, basically, again, to pump into the banking system. That's the nature of what started to happen in 2010, and that continued through the whole decade.
Yeah, that's great. I think as one of the key learnings for me from your book was this asset inflation versus price inflation, where it's really important to look at, oh, stock market go up and housing go up. Is that necessarily good, or is that just too much money chasing too few assets? And it's like, oh, okay, great. This thing is being pumped up by these assets, so that's smart. I think also one of my listeners had a question. I asked them, what they want to ask you, and one of them was about the why we price inflation versus asset inflation, why price inflation didn't happen as much during the 2000s and et cetera. And it sounds like, yeah, globalization had intense deflationary effects on the economy. And so it was able to keep kind of prices still low because it was being outsourced and stuff was being produced in these ways. And so it was too much money, but that money, the goods, there were more and more of those goods as well. And so it was just the assets that went up and not the goods. So that kind of makes some sense to me. And then, as you say here, I think that it's a crazy, and I think thinking of the Fed and thinking of the U.S. government, or whatever it might be, this like whole system as some kind of weird blood sucking leech, some kind of weird addictive personality, where it's like it's already at 0%, and then your quantitative easing on top of that is like, it's almost, if you were in the 1970s and thought, and you're like, oh my God, you're telling me that the rates are at zero? That's crazy. And then what did you do? You just seriously just like pumped out money and did quantitative easing and bought all these mortgage-backed securities, all this stuff, just pumped out. You went from, whatever, 1 trillion to 2 trillion and then up to 4 trillion, 7 trillion. It's like, that is crazy. So yeah, so that is, and so tell us about, I guess, so we have this kind of picture of there's all this easy money out there now. What impacts did that have on the economy and on people?
Oh my God. I mean, okay. So, like, how do I even start? Um, Initially, when I started the book, it was called "The Lords of Easy Money: How Quantitative Easing Changed the World." Because it's like you were talking about. If someone from the 70s was looking at it, they'd be like, "Oh my God, you quadrupled the money supply in like 5 years." And to me, as a reporter, per that first interview, I'm like, this is a step change. Like, this is a dramatic change in continuity in history. So as a reporter, you're like, I want to write about that. By the time the book is published, the subtitle is How the Federal Reserve Broke the American Economy. So, like, what's going on there? What effect did this have on the real world? Not a great effect. And I'll give you just the headline really quick. It dramatically widened the wealth gap between the very richest and everybody else. It dramatically increased risk in the system. It pushed all these banks to get riskier and riskier and riskier in the things they bought and the things they invested in. And then finally, it enabled an enormous uptick in debt for private people, for households, for governments and corporations, and for the government. In another way, in my view, when you look at those risky speculative investments coupled with the enormous upswing in debt, it made our financial system way more fragile and vulnerable. Just huge. It just built such fragility and vulnerability into the financial system. I am telling you, I talk to people on Wall Street all the time. They are not like happy right now. They are not optimistic. They're not sanguine. I met with this private equity dude in commercial real estate they're just sober. They're sober. And it's because they realize what a house of cards this whole thing and how far down the drop is going to be if the Fed really does try to tighten conditions as the Fed is trying to right now.
Yeah.
Okay. I don't know. I can get granular on the effect really quick if you want.
Yeah,
That
yeah,
was
that'd be
like
great. I was going to say, yeah, tell us a little bit more about, because I think it's interesting to know how it creates the wealth gap and how it creates the why there's a lot more debt, stuff like that.
totally. And why the investments are so risky. Okay.
Exactly.
So
Exactly.
for 7 years, interest rates are held at zero, which I can't overstate how radically unprecedented that is. They'd never really been at zero before, and then they were there for 7 years. Okay. And then the Fed is pumping $3.5 trillion in between 2010 and 2014. So the way I like to look at it is, let's say you run a hedge fund on Wall Street or a private equity firm. I mean, your job is to invest. Interest rates are at zero. The ability for you to like safely save money might as well be nothing. I mean, 10-year treasury bond yields were down at like 2% at times like that. And I like to think of the 10-year treasury bond as like the savings account for Wall Street type people. That's where you can put your money that's totally risk free. Now, if I can earn 5 or 6% saving my money, and you come into my office with an investment idea, it had better earn more than like that 4 or 5%. You really have got to do some convincing to me. Like, hey, look, man, this is my business plan. This is my management team. This is our long term. And I'm like, okay, I'm going to pull my money out of that 6% savings account and give it to you. If the interest rate's at zero and trillions of dollars are now pushed into the Wall Street banking system, and you come into my office and you're like, I don't know, I've got this idea, probably won't go bust. I'm like, here you go, man. Of course, I'm oversimplifying, but the Wall Street types call this effect the so-called reach for yield. They needed somewhere to pump to put all this cash. So they start buying junk bonds, for example, for frackers in North Dakota who are like wildly overestimating how much oil they're going to drill, who have like ridiculously bad management teams. But Blackstone is like, hey, whatever, man, we'll buy your junk debt. Your promise of yield is higher than anything we could get saving. So literally hundreds of billions of dollars of cash starts to roll out into the economy. And then in the same environment, you're like, I'll buy Tesla stock for this price that's like insanely high. Like it's basically priced as if every car in the country will be a Tesla by the year like 2040. But okay, I'll buy it. And all these markets for assets, corporate junk debt, tech stops, they go up. It builds this huge bubble. And this is an asset inflation bubble that's going on steadily for 10 years. Now, the wealth effect, why did this increase the gap between the rich and everybody else? According to the Fed's own numbers, the richest 1% of people, this like infamous cliche 1% group, who I almost feel sorry for, they get beat up so much, but it's just like, this is our era. But like the 1% own 40% of the assets in the country. 1% of people own 40%. The bottom half of Americans, 50% of us, own 5% of the assets. So when you have a policy like quantitative easing that is driving up asset prices dramatically, you're by math benefiting the 1% way, 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 way more than everybody else. And just meanwhile, like this kind of activity is speculation, risky investment. Look, wages were flat for a decade. Productivity growth was extremely weak. Overall economic growth was weak. The financial markets were supercharged. But so like this was a decade of like the stock market doubling, the corporate debt market doubling. Everybody else is kind of treading water. And for all this trouble, what you get at the end is a banking system that is like teetering in the sense that it is gorged up on so much risk. The asset prices are so inflated that one pinprick can set off a terrible chain reaction.
Yeah, I love that. That's yeah. It's like, and you can kind of imagine it as there's all this money that's being pumped into the system, all these, and it's being pumped in by sucking out all these assets that were kind of risky. Oh, give us your mortgage-backed securities, give us your whatever, we'll give you this liquidity now. And then that money goes out there and it's like, okay, what should I get now? It's like, well, I'll buy that some junk bonds, I'll buy some some NFTs, I'll buy some Tesla stock. And it's all in this asset inflation. And as you say, it just creates this massive gap between the rich and the poor there, because all this money is being pumped into central banks, which can pump it into assets, and then everybody who has those assets gets money, but everybody who doesn't get that money. And so it's kind of like a reverse UBI, where you're like only money to the rich, not money to the to the poor. And as you say too, I think the risk, towards riskier investments, and then the debt is really intense too, because if you look at corporate debt, it's it's gone up from roughly 100% to 200%. And what it is it's all these people. There's all this easy money, and so what they're doing is these stock buybacks. And so they're like, good, we'll just take this free money, and the whole ball game to for the CNBC traders and for everybody is to increase equity prices. And so we're going to spend this. We're going to borrow $1 billion and then do $100 billion of stock buybacks. So there were whatever $7 trillion of stock buybacks, all just making all this money go up, go up, go up. Well, that's debt though. That's they got, it was free money, but then where does that free money come from? And so okay, so that's kind of the situation we're at. We're at this hyper leveraged kind of debt thing with lots of wealth inequality as a result. And I guess I have a question for you, which is, can you go in an additional kind of like 10 minutes, by the way, or do you have to?
Oh, dude, I'm good.
Okay, great.
I can go as long as you want.
Yeah, great. Well, we'll go for probably like another maybe 15. So that's the situation, and I guess let's bring it into the current moment, which is like, how does something like Silicon Valley Bank connect to this? And this overhang of all these, all the hold to maturity kind of $620 billion of these long-term. So tell us about like the current moment and how SVB kind of connects to, if it does, connects to this current macro easy money environment.
100%. Okay. I'm going to make it real quick. By 2020, before anyone even gets a cough from COVID, we were already so deep in on this like easy money experiment and program. The system was starting to short circuit in 2019. It's really, really, my favorite part of the book is from 2018 to 2019. The Fed was trying to raise interest rates again because they knew all the stuff you and I are talking about. They knew it was happening. And they're like, we got to pull back on this. So they started to raise rates. They started to pull some of this money out, and the system short-circuited. Repo bailout, September 29th. Yeah.
Tell me about that, because that was something I've read, and I kind of got it, but didn't really get it. So tell us about, that repo bailout.
Dude, I did a whole chapter on it.
Yeah.
It's amazing. Let's just put it this way. The Fed was trying to raise interest rates again. They got up to 2.5%, which historically is really, really, really low. And then the Fed was trying to reverse quantitative easing. But the banks were operating on top of this gigantic pool of money. And the Fed took too much out of the system, and what was supposed to be a very safe, predictable overnight loan market called the repo loan market was the cost of an overnight loan, and this is the lifeblood of Wall Street, the repo market. In mid-September 2019, the cost of this loan goes from 2.5% to 10%.
And as a side note for listeners, these loans are kind of like the bonds into short-term liquidity, but it's like a short-term thing where it's just like, hey, I just need some short-term liquidity. Give me this little loan that I'm going to be able to pay off some stuff, and then I'll give it back to you in a second. I just need the short-term liquidity, but I'll give you the 1% or the 2%. Is that right?
Totally correct. And the basic thing is like, this is how Wall Street funds itself.
Yeah.
And to go from 2.5% to 10% is like Lehman Brothers collapse numbers. And the Fed was totally caught off guard. I interviewed the people who were in charge, John Williams at the New York Fed, Lori Logan, his market woman, the woman over the market trading desk. It was a crisis, and they printed $400 billion through quantitative easing to stop that crisis in September 2019. And it was this huge acknowledgement of like, we can't even get rates up to 2.5% and bring our balance sheet down to like 3.5 trillion without causing major problems. It's just like this sign of like, wow, we have really distorted the market, and getting back to normal is going to be really, really hard. So that happened. And then that brings us up to like December of 2019. Interest rates are at 2.5%, and the Fed is already like, we can't really totally stop quantitative easing. The way to measure quantitative easing is the size of the Fed's balance sheet, which went from $1 trillion, remember, to $4.5 trillion. They managed to bring it down into the threes. Okay. COVID hits. COVID was a once in a generation, hopefully, crisis that was going to be bad no matter what. But this crisis hit a financial system that was tremendously vulnerable. I mean, just even at this time, like the really smart people knew we were in for a tough road. The Fed, in response, printed 350 years worth of money in like 3 months. The balance sheet goes ultimately from 3.5 trillion to 9 trillion. Okay. Back in the 2000s, everyone was freaking out and having all these debates about the Fed when the balance sheet was 4.5 trillion. Today, it's just a little under 9 trillion. And the Fed directly started buying corporate junk debt. What I'm saying is they faced a crisis that was exacerbated by the easy money policies, and they just handled it by tripling, quadrupling, quintupling down. Okay. So that brings us to 2021. The balance sheet's like 9 trillion. They've stopped a crisis, and then inflation hits. And am I still good?
Mm-hmm. Yeah.
I had a little video lag. Okay.
Yeah, you're good. You're good.
So then in 2021, inflation hits, which is terrible for all of us. And inflation goes to like 9% really, really quickly. And, the lesson of the 70s is that when you let this fire burn, it gets out of control really fast. Inflation is gnarly and terrible and destabilizing, and we should all be worried about it. It's not great. It's terrible. And this is what's so important to understand now is the Fed had gone so far down this road of easy money with a $9 trillion balance sheet, interest rates at zero again, and then they had to hike rates to stop inflation. And in 2022, they hiked rates. They had gradually kind of done from 0 up to 1. And then in 2022, last year, they go from 1 to 5, basically, a little under 5. That is the fastest rate of change since even before the 60s. Like, even when they had to hike rates to kill the great inflation, the rate of change wasn't this dramatic. I don't call it an interest rate hike. It was an interest rate shock. And it's going to take some time for that interest rate shock to bleed out through the system. And so my whole point as this guy who's written this book and is critical of the Fed, at the end of last year, I was like, here's the thing, folks. If Jay Powell keeps the interest rate at 5% for a year, we're going to see stuff that is ugly. But if he cuts rates, he could be making the mistake that they made back in the 60s of cutting and then raising and then cutting, and then we get inflation. So, okay. My take on it is like, dude, we're like 3 months into 2023. 3 months in. Silicon Valley Bank has failed. A mega bank in Credit Suisse has failed. And we're 3 months into this thing. And Jay Powell is saying, yeah, the whole Fed, the whole FOMC is saying we're going to keep rates at 5% this whole year. And so we can get into the details of why Silicon Valley Bank imploded and what was the other, like Signature and First Republic, domino. Credit Suisse is a mega bank, man, and it's done. It's gone. It's owned by UBS at the mandate of the Swiss government. That's intense. And everybody's kind of acting like, oh, it's like just whatever. So everything's okay. But it's not. And it's going to take a while for that 5% rate to really bleed through. And as it bleeds through, it will manifest in a downward adjustment.
Yeah. I love that. I think it's a good, and it's like, as you said, well, hey, yeah, learning about that repo thing is interesting because that didn't get any, coverage or whatever. So it's like, oh my God, this like repo rate, for the Wall Street bankers, it was just like a little sub niche for them. That was a big issue. But then, and then, we just go and we kind of 3x'd it from, roughly 1 trillion to 3 trillion before. And then we 3x'd again from 3 trillion to 9 trillion now. And so it's like, okay, there's so much money out there. And then when you hike the rates, you kind of have to, you're sucking that money back from the system. And you're saying, look, if you want to get a loan, you're not just going to be able to get free money out there anymore. If you want to do this, it's not just free money. And so the amount of demand decreases and all these things start to decrease. And then for someone like, Silicon Valley Bank, it's like, oh, you have all of these, held to maturity, these, 80, there was no, as you said, everybody's searching for yield. There's no yield. They're like, we'll just buy these long-term treasury bonds, these safe ones, but they're, for 1.5% or whatever. But then once you increase, rates, then those bonds decrease in value. They decrease in value a lot, and so you're then down, $20 billion or whatever because you bought the only safe thing remaining, which wasn't even safe. And so I'm curious, what do you think about? And by the way, we can go longer than 5 minutes. We can go up to if we got time. How do you think? So what should the Fed? I guess I do want to get into slightly around, which is one is what should we do now? So like, what should the Fed do now?
Oh my God. And by the way, I will answer that unsatisfactorily, by the way, but like Silicon Valley Bank, you explained it perfectly right. The Fed hiked rates and those bonds dropped in value. Here's what I love about this, though. If you hold the bonds forever, you don't have to mark down the loss of value. And it's called an unrealized loss. When you look at the banking system right now, the unrealized losses of these treasury bills is 600 billion. Okay, that's true. What's messed up though, you don't have to mark that loss down basically if you're a big bank until you sell some of the bonds. And then you have to mark the loss down. So if you can hold off and not sell any, you don't have to realize the loss. If you're Silicon Valley Bank and people are starting to pull money out and you need to raise capital, you got to sell the bonds. You got to accept the loss. The loss becomes public. And then Janet Yellen is like bailing you out over the weekend.
And
So
that's, by the way, the BTFP, which is this, everything's a facility, the bank term funding program, and that facility, all these things are maturity transformations. What that allows you to do is it takes any of these long-term bonds, this 10-year thing, and you get to put it into this little bucket, and then the Fed gives you money right now in return. And so that's kind of that's how the Fed has kind of helped these banks that have the 620 billion dollars of unrealized losses. You can get those at par. You put them into a little facility, and you can get money today. It's like a new form of quantitative easing.
But if you call it quantitative easing, they'll lose their minds and tell you don't understand the facility.
Exactly.
Okay, I mean it's the same thing. They will create another facility to pump money in to pick up the loss from the distortion that they've created. Okay, but like that's a really hard question. As throwing it back at me, like
what should the Fed do? Yeah.
What are they supposed to do? First of all, inflation is scary. Like it's not to be played around with. There are these. I've read a couple great books about the hyperinflation of Weimar Germany, which I know is not really applicable. There's so many huge differences. But look at right now, today, Beirut, Lebanon, Nigeria, Lagos, Nigeria, Turkey, they're all having massive currency crises. And it's ugly. It's destabilizing. So the Fed needs to take inflation seriously. The best thing that could ever happen to us is if inflation just mysteriously declines rapidly down to like 2%. It's at about 6% now. The Fed does not foresee this happening. But if it does, it would just be such a miracle. It would be so great because then we wouldn't have to face these trade-offs of keeping rates elevated to kill this inflation and accepting the carnage that happens. What should they do now? Can you tell I'm trying to like avoid this? I mean, because they've got to fight inflation, but that's going to require accepting a great deal of like economic pain. I think that they should stop prioritizing the well and this is going to sound like such a cliche, but stop prioritizing the well-being of the too big to fail banks and the too big to fail shadow banks like Blackstone and the richest Americans who have the best phone line into the Fed and Congress. Those folks have gotten bailed out like to the 100 cents on the dollar pretty much every single event since 2000. And all that's doing is perpetuating the problems and reducing Americans' faith in the system more and more each time. But I mean, yeah, I don't know, man. This feels really easy and glib for me to say. Instead, if I was like sitting on the Fed committee right now and they're like, what are you going to do? Um, I'll just be totally blunt with you. We are in a terrible situation, and I don't really have the answer. I mean, fight the inflation, try to contain the damage to the degree you can, and stop putting the richest and the biggest banks ahead of everybody else.
Yep. I think it's a good, and I kind of come to a similar conclusion, which is that it's hard, but I think you kind of have to keep rates. What you want to do is you got to suck money out of the system. There's just way too much money in the system. And so it's like, and so this is, I see it as kind of like a 5-year, decade-long program where it's like, yeah, you have to keep rates at 5% or whatever it might be for an extended period of time. You want to get people back to a normal reality. As that happens, as you say, I think, and you're essentially choosing, it's like a poison or whatever, like between a rock and a hard place, where it's like, you have to choose that. And what you have to do, and you do a great job of this in the book, like in the 70s, or sorry, in the 80s, the 70s and 80s, as people were like, oh, we need to actually hike rates a bunch. The role of the FDIC and of Thomas and these people in your book, what they had to do is they had to do this mop them up operation where they're like, okay, you're coming to us, you're requesting some money, some kind of facility for now. Do we actually think that is, and you have to take this equity lens where you're like, let's not just help the rich, but let's try to help everybody. And it's going to be, whatever, 1,600 banks failed between 1980 and 1994. And so it's just like, I feel like that's part of the ballgame right now. It's like, that's what needs to happen as a way to kind of get out of the age of easy money and back into something that has some connection to reality. So that's kind of where I land.
And let me follow up on
Yeah.
that. You know who we're not talking about is Congress and the White House. But a biggest part of what I talk about is how much power the Fed has taken onto itself. But like the dysfunction of Congress, that's like a luxury they have thanks to the Fed. And so these problems we're going to face, I don't care whether you're super conservative or super liberal, whether you think the answer is to like abolish all regulation and taxes versus have another New Deal and build more dams or whatever. Congress has got to step in and legislate to contain the damage, to rebuild. That's what they didn't do after 2008 to a significant degree. We let the Fed try to print money to get us out of the jam. But, by the way, after the Great Depression, the first thing FDR did was take over the banks and nationalize the toxic banks. And then, they imposed strict antitrust laws that broke up banks. They created the FDIC. We've got to have an absolutely similar regime. I mean, we got to get into it to take on the powerful vested interests, which I know sounds like such a cliche, but like the really powerful people of money who run Wall Street. Like this thing's got to get taken on. And so, yeah, fiscal democratic authorities have got to step in and start doing their job.
And that was for me a big learning about diving into this is the difference between fiscal policy and monetary policy. Monetary policy is just changing the interest rates, doing more of printing more or less money, and fiscal policy is like the New Deal or the IRA or these things where you're like where Congress passes a thing and pushes it towards actual infrastructure that we want as a society. And as you say, and I have a piece actually that I'm writing right now called Vetocracy Made the Money Printer Go Burr, the housing theory of everything in the age of easy money, which is exactly what you're saying, which is that we have this vetocracy. And then because in 2001 and 2008, we're like, can we do anything? And then Congress is like, no, we kind of don't forget, we're a totally dysfunctional body. Then you say, okay, I guess the only hammer left in town is the Fed. So the Fed just has to print stuff. And so we're bad at, and this is the housing theory of everything too, which is that there's a because we have a vetocracy of housing, housing doesn't get built. And so we have the two parts of money, too much money chasing too few goods. Well, we have too few goods. There's too much vetocracy, so there's no housing. And then we also have too much money because the only thing we can't do normal fiscal policy and create infrastructure. We can only do monetary policy and just like nail that hammer more and more. So yeah, it's kind of, we're in a bad place. So I have a question for you, which is, do you think, what should individual do here? What, this again, a question from a listener. And also I was like telling my dad, I was like, hey dad, just to let you know, like the system's not in a great space right now, but I didn't have any recommendations for him. Like, what should you get exposure to? Should you get into cash, out of cash? Should I just buy gold and put it under my bed? What should I do?
Oh my gosh.
Not financial advice, obviously, for anyone who's listening, just brainstorming.
Yeah, but I get that all the time. And like, grain of salt. If there's and this isn't helpful, but like, if there's one thing I've learned from covering these people, we are the last people to know what's going on. We're like 3 rings out from the poker table. And if you think you're going to like outtime Wall Street or it's just not feasible. I'm conservative. I work hard. I try to save as much money as I can. I've got a 401k, and I don't try to mess around and time the market. And when a real storm comes, so to speak, I would be very hesitant to put my money into gold, because like everybody who knows what's going on has thought about this like 5 steps ahead of us. So again, unfortunately, I think it's like a conservative approach to like, don't try to time the market, put as much money as away you can, work hard and make yourself as productive as possible. But then from a public policy standpoint, we've got to address these issues, break up the big banks, get Wall Street back on its leash, do policies that empower wage earners in this country, who are trying to do it themselves through unions or all the rest of it. But these are like policy prescriptions that you and individuals, I think all we can really do. And it's tough because we've lost a lot of political power in this era because everybody's so like atomized, like individualized. But this is a big program of trying to, push American politics back away from vested interests and special interests toward the middle class again, which will be a long struggle.
Yeah. But yeah, and as you say, it's kind of, for an individual on one side, it's kind of, you can just do what you can, which is, we're many seats out from the actual poker table. They're thinking about this as their daytime job. And so like, we can just keep doing, what we've been told or whatever. And, it's funny too, because as you talked about with like getting, kind of breaking up the big banks and getting kind of like strong, this idea of strong state libertarianism, where it's like, let's have the strong state again, to like actually markets and state work together. And there's this great piece in the Age of Easy Money, which is a PBS documentary that you were also in. And they have this clip of this amazing guy who's one of these like like a famous bond trader, equity trader, or whatever. And he says, the crazy thing, talking about taking down the banks or whatever. He's like, and the percentage of GDP that has gone to finance has gone in the last 30 or 50 years from 3.5% to 8.5%. We're like a giant bloodsucker, but we do not generate any real increase in income. We are just a cost. It's like that's what we have right now, is a hyper financialized system that needs to get unfinancialized. And who knows how that's going to happen. So I have a question for you too, which is kind of taking a step back. And maybe this is like maybe my final kind of series of questions for myself and the listeners, is like, there are, so in my world, there's kind of two things that are happening. I'll talk about one of them first, and then we'll talk about the other one later. The first is, there's this guy, Balaji Srinivasan, who has this Bitcoin. Have you heard about the Bitcoin bet, the $1 million Bitcoin bet?
I saw. I don't understand it.
Yeah, totally. It's the rough deal is that Balaji, who is a very sharp guy, but kind of hyper libertarian, kind of crypto energy, and I personally have some crypto energy too. But like, so he's there and he's saying, look, what you can, he's mostly, he's being kind of extreme about it, and he's saying, hey, there's going to be hyperinflation, and so everybody should put their money into Bitcoin, because that's kind of because hyperinflation is coming, and there's too much money in the system, and as the debt grows, we're going to have to monetize it by printing more money or whatever. And so I think what he's pointing at, he's kind of an extreme version of it, but I think the bell that he's ringing is this really good bell about there's this great Ray Dalio YouTube video and also book called Structures of Economic Order or something like that. And it's kind of about the rise and fall of empires. And you can look at these empires where at the beginning, they kind of are really good at education. Then they start to create things, do innovation, do all these other things, healthcare, whatever. And then they eventually become the world's reserve currency. And then eventually, and this happened to Netherlands before us, this happened to the British pound, and this is maybe now happening to the US, is like the US has done all this stuff. We are the world's reserve currency. But then at the end, because we're the world's reserve currency, we're essentially pumping out, people want our money. And so we kind of give people these bonds and then take their US, or we give out the US dollars and then we take these bonds. We're sort of just getting more and more debt as a nation. And then eventually what's going to happen is with all of that debt, without as much production on the back end to eventually pay off that debt, that our reserve currency status will be kind of given to China in the end, which is, I think, inevitable. But so I guess I'm curious for you, like, that kind of big picture story about U.S. and kind of how we are, a world power and how we have the world's reserve currency. Is this whole money printing regime kind of like a canary in the coal mine for this bigger kind of shift away from the US dollar as a reserve currency? Do you have any thoughts on that?
This is something I think about all the time. It's all tied together. I mean,
Yeah.
the United States empire is a word we're really hesitant to use because of our anti-imperial past, and our empire today is a very fascinating kind of like neo empire hegemony with the reserve currency. So where are we as a nation? I mean, geez, there's a whole cottage industry to like the collapse of the American system theory and all that. What we can say for sure is that this is all intertwined. I have no confidence to be able to say that like we are entering the end stage. And this really is, you'll hear a lot of people say that this is totally symptomatic of debauching the currency, empire rotting from the inside out, unsustainable levels of debt. Um, Very sound arguments, to be honest. But also, the world is really unpredictable, unexpected. America has a lot of intrinsic strengths that don't get recognized enough. Other nations that would compete with us are somewhat disastrous. I mean, China, very interesting setup. Okay. But China is also, have you heard of this economic analyst at Credit Suisse named Zoltan Pozsar?
No.
Dude is brilliant. Dude is brilliant. He predicted that repo crisis you and I are talking about. He's like the only guy on Wall Street who did. He's been writing almost primarily for about a year about China sort of patiently and consistently building an alternative to our reserve currency by pricing commodities in yuan in Saudi Arabia. Look, it's not going to happen overnight. It is happening right now today along the margins. And all I do know is that if we do not maintain our status as the reserve currency, it's going to change everything we know about like our system. It'll be totally different. Our currency will be the subject of harsh market discipline in the same way currency is in those nations I mentioned, like Lebanon, Turkey. I mean, it's gnarly. And we're not going to have this incredible privilege of being able to issue debt. And then when there's a financial crisis, people want our debt more. Like it gets easier to borrow. And so if I could like talk, I mean, I think about this a lot, man. Look at our 20-year occupation of Afghanistan as well, and some of the policies going on there that really didn't end well. Restraint. That's what the Fed did not display in the 2010s. It did not stay inside its lanes and try to do moderate monetary policy that would have like less intense side effects. If they had shown more restraint back then, we'd be better off now. And so when you look at where we are today in the global currency markets, I keep saying like there's a red line where people will lose faith in our currency and we won't be the reserve currency. We don't know where that red line is. Could be 5 years, 10 years, 20, 50, 100 years away, but we like seem determined to find that red line. You know, it's like, let's just do whatever we can, borrow as much as possible, fund as much of our budget through deficits, punish everybody through sanctions that are only doable because we are the reserve currency. And it's like, we can't act without restraint like this anymore. We need to like steward our resources better. That's my take on it. Like, I have no idea if this is the end of the American empire. You know, all I know is like, we're not invulnerable. No nation ever has been. And so we need to really be adult and think about this stuff.
Yeah, I love that. I think it's, again, I think, yeah, being an adult is a good way to think about it, and like being in restraint. And I think that, as you said there, it's a, who knows what's going to happen and what the timeline is, and I think that, but it is this kind of crazy situation that we're in, that, like, if you think about the shocks that Turkey and Nigeria are experiencing now are similar to the Arab Spring kind of food price shocks after 2008, where it's like 2008, and then we kind of printed, and it's hard to kind of connect these dots, but there's something about us printing more money. We get the more money. The people who held our money, they don't get the printing. They just get a decreased, all the stuff that they had, that just decreases. And they're looking around, they're like, wait a second, we're experiencing lots of inflation. Our food is costing more, whatever. And then the Americans over there just kind of continuing to eat Burger King. And so it's like, we are kind of pushing out that kind of disorder onto the system right now. And eventually, when we're not the reserve currency, it will be impacted on us. So yeah, I agree with that. Let's go to another kind of big picture one as the final question here, which is, this other guy, David Friedberg, is a good guy who thinks about, like, kind of in a systemic way about these kind of the system as a whole, and how money's flowing and all that kind of stuff. And what he was saying, he's just like, look, we have a system this is kind of like a capitalist, post-capitalist question almost, which is like, we have a system that's built on debt. Everybody, the government issues debt, companies issue debt, everybody issues debt, and then and they're kind of, everybody's searching for there's all these loans, these borrowers, these sellers, and you're trying to build things so that there can be growth, because only if there's growth, then can the debt be repaid. Because at the end, it's like, okay, I had this loan for 5%. I went out there, I made more than that, and now I can give you back the thing. And so, I guess, is there any kind of philosophical take on, like, capitalism being built on growth, which is being built on debt, and we have this system full of debt, and is there another way to kind of square that circle that's like a way? And what David was saying too, David Friedberg, he was like, because we're so built on debt, and then, but when the system, and I'm built on growth, but when there's something like COVID, which is a deflationary event, it's like, the system can't think in ways that aren't growthy. If it's like no growth, well, that's not how capitalism works. And so it's hard for us to have this retractionary period when the whole mindset and system and instruments are all built around growth. So do you have any kind of final thoughts on that?
Dude, I'm just a reporter, man. Like, I can tell you what Bernanke said during the meeting in 2012. Like, that's my job.
Great,
But
great. What do you say? What do you think? What do you think?
no, not even on this topic. But like, okay, it's out of whack. Okay, this is going to sound really like, I'm not a philosopher. It's out of whack. What I've been talking about with these monetary experiments has pushed the system way out of alignment. And part of that, you have to go back to even before the financial crisis itself, when you had banks that were too big to fail, that were allowed to merge, that were allowed to speculate while they also enjoyed public insurance through the FDIC. Like, that whole thing is a mess. And where we find ourselves now is that this isn't just a capitalist system that increases productivity and output in the old school way to pay down debt and uses debt as a mechanism to feed that system. We're now like, debt is the fuel. That's what I'm talking about when I talk about broken the U.S. economy. We have pushed way over here to this side of the spectrum, where they talk. I mean, the people who ran this policy talk about it. How you talked about it. You're pushing money into the system. People are just using it to borrow and buy back their own stock because that's more profitable than actually, like, building a research lab in suburban Decatur and trying to find new products that you will sell to people. Well, why would I do that when I can borrow money at 0%, essentially buy back my own stock, and because equities are going up, that will, I'll make money that way. So now we've got a system that isn't just like built on debt, but is taken over by debt. Like this fungus has just grown and grown and grown. So I I'm I feel like we got the formula pretty correct after the Great Depression when we did the New Deal, which was mixed capitalism. We we stoked research, we built huge companies, we produced things and sold them, and I know we had this position of like the only surviving industrial base in the world, but also like our economy is structured in a way that when the money came in, like the middle class kept it a lot because they had power and bargaining power. The banks were kept on a leash. What that guy was talking about in the special Age of Easy Money of going from 3.5 to 8.5%, like that wasn't happening. And so I'm an advocate, I suppose. Like I really do think my core job in life is to be a reporter. That's what I'm good at, is like finding out what happened and writing it up and giving it to you. I'm not a policy guy, but like we seem to have gotten it pretty well. We had a good formula with the New Deal, and it's not revolution. We didn't become a socialist nation, but we also didn't, become a hardcore laissez-faire libertarian with zero government. It was a mixed economy. And I don't know, man, that kind of like unhappy compromise seems like probably a good direction for us to look toward.
Yep. I love that. Yeah, that imagining a future where debt is used to fuel capitalism, but not infinity debt, not a fungus around everything, and that we have this strong state libertarianism, some kind of New Deal kind of energy where there's actual fiscal policy happening that pumps infrastructure, that helps education, that helps roads, that helps transportation, and then that eventually comes back around and helps creates the GPS and the internet and all these things that then help the rest of the world. So that is hopefully what we're going to get back to. Let me ask two little overrated underrateds, which are, I'm going to say an overrated, I'm going to say a thing and you'll give me like a one sentence version for why it's overrated or underrated. And so the SVB collapse, do you think that was overrated or underrated?
Underrated in its significance. I just went on a show on Yahoo Finance, and there was a very sanguine attitude toward the SVB thing. Like, okay, they took care of it. And I'm like, are you kidding? Like, no, highly underrated.
Cool,
Okay.
cool, great. And then what do you think about, there's 2001, there's 2008, there's like .com, then there's like Great Recession, and then there's kind of COVID. So which, kind of compare, is 2001 the impact of that kind of crash overrated or underrated? Is 2008 kind of overrated or underrated? And is 2020 kind of overrated or underrated?
Man, I would say 01, 08 properly rated. Like we understand, particularly with 08, that it was a epochal crisis. Underrated how little we did to actually like address the problem in the financial system. I think COVID, underrated. Dude, we had a financial crisis in March 2020 that was worse than 08. The treasury market froze up. The deepest, most liquid, safest market on earth froze up. As the Financial Times said, that was not supposed to be possible. And the Fed only fixed it by printing north of $4 trillion. So underrated and obscured by the money printing. Level of danger today, totally underrated. And again, man, I just got to say, like, I'm not like this natural Cassandra. Like, my life is not like I'm a short seller. I'm not like Nouriel Rabini or whatever. But I am just telling you, like, 5% interest rates is a five-alarm fire, dude. We haven't lived in that environment since '07.
Yeah.
So SVB underrated. I'll circle back to that one big
Yep.
time.
I love that. And I think it's kind of like a thing where you can kind of imagine it. It's not like you're pointing at every little thing. You're like, this is the craziest thing I've ever seen. It's like, no, you investigative journalist on the things that sound crazy and intense. And then if they end up being, boom, here's what you write about. And I think the other piece here is you can imagine kind of like how we did the, like, if someone from the 70s was here today, they'd be like, oh my God, that's crazy. And hopefully it's the case that someone in 2070, when they look back on us and they're like, oh my God, can you believe we were just printing money into the system and 0% interest? It's like, that is hopefully what we're going to look up at this time as, is like, wow, that was the mistakes that were made in the 60s, aka the mistakes that were made from 2008 to 20, so like, we'll kind of look at those as kind of mistakes that were made. Well, beautiful. Well, thank you, Chris, for going deep on all this stuff. If listeners want to check out Chris on Twitter, he is C Leonard, that's C and then Leonard, his last name, Chris, C Leonard News. And then also check out the book. It's called The Lords of Easy Money. It was a good kind of deep dive into, a deep dive, but also an easy read about like what was happening within these systems, and also the people, the kind of the people side, which we didn't touch on too much today, is like, who are these people who are at the Fed, at FDIC, and how did they kind of connect to these various different crises over time? So definitely check that out. And Chris, anything else to say to our listeners?
No, but thank you for the great conversation. I really appreciate it. And I guess, like, buckle up. Like, let's get through this. It's going to be a gnarly couple of years. But if we understand what's happening, I think it'll help decision makers a lot better, hopefully.
I love that. Buckle up. Just do the good work you can as the craziness occurs, and just keep on trucking, and we will get through it. Beautiful. Thank you so much, and goodbye, everybody. Thanks so much for listening today. If you like the show, please give us a 5-star podcast review or subscribe on YouTube. And if you'd like to chat about this episode with a community of amazing, smart, ambitious, divergent people, come on by and join our Discord. You can find it at root.co. That's ROOTE.co. And then finally, if you'd like to contribute to these ideas being shared more widely in society, you can support the podcast production team at patreon.com/Rhys Lindmark. That's patreon.com/RHYSLINDMARK. Thanks, and see you here for the next episode. Bye.